Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Welcome to Reverse Mortgage Radio. I'm Bruce Simmons, your reverse mortgage professor. Every week on this show, we talk about how reverse mortgages work. We clear up myths and help you make smart, confident decisions about your home and your future. Today, however, I want to talk about something that almost every homeowner asks me about when we sit down to talk. They say, why in the heck do reverse mortgages have mortgage insurance? They tell me, I've never had mortgage insurance, or I haven't had mortgage insurance on a loan since my very first home. And it's a great question because most of us think of mortgage insurance as something that protects the lender, not the borrower. And that's how it works on regular forward mortgages. In fact, it works that way somewhat on reverse mortgages too. But there are a lot of benefits to the homeowner as well. And it indirectly protects the homeowner by protecting the lender. But with a HECM reverse mortgage, the FHA mortgage insurance is actually, I really venture to say, it's one of the biggest benefits that you as the homeowner have with a reverse mortgage. It's what makes the program safe, reliable, and sustainable, even through changing markets, long lifespans, and unexpected events. So all that stuff it protects you and your heirs in that situation. So today, what I want to do is we're going to take a little trip through history of the HECM program. I'm going to explain why the reverse mortgage insurance program exists on the HECM. And then I'm going to give you the top 5 reasons. That's the gist of the show. The top 5 reasons mortgage insurance is actually a good thing. You bet it is. That's what we're going to talk about today on Reverse Mortgage Radio. However, real quick, a quick public service announcement. I apologize for the way I sound. I came back from a trip with my wife. My wife and I went on a trip recently. Of all things, I came back with an ear infection. I'm 60 years old. When I was a kid, I had ear infections all the time until I was about 8 years old and got my tonsils out. And I never had another ear infection again until I was 55. And I had a weird ear infection. And then when I'm gone this time, a week into this trip, I get this weird ear infection, and it's been bugging me at no end. And I get home, get to the doctor right away, get some antibiotics, and start feeling better. But my wife, instead of bringing an ear infection home, she brought a good cold home. And she was miserable for a few days, and she promptly gave that cold to me. So I apologize the way I sound. Now I'm getting over the ear infection, but I've got this massive cold now. So if I have to stop and blow my nose, you'll know why. But before we get into the gist, all the good stuff about reverse mortgages, if you have any questions about reverse mortgages, please, you need to give me a call. You can reach me directly. Call me on my cell phone, actually, at 303-513-2748. 303-513-2748, or visit me online at reversemortgageradio.net. It's reversemortgageradio.net. You can go on there and download my free consumer guide. Lots of great information there. You can watch video testimonials of actual customers from me that I've done loans for. You get a lot of good information. You can get a free quote, all that good stuff on my website at reversemortgageradio.net. Let's also, before we jump into the meat of this, talk about what a reverse mortgage is and kind of in general, real quick, how it works. So most reverse mortgages are considered FHA insured reverse mortgages. It's called the Home Equity Conversion Mortgage. And that's the program we're going to talk about today. That's the one that has mortgage insurance on it. A few weeks ago, we talked about the proprietary loan, which does not have mortgage insurance on it, but they make up for the lack of mortgage insurance with a higher interest rate, a lot higher interest rate. And for some people, that program works fantastic. For most people, the HECM program is the better program. And that's why I focus on that most of the time during this, on this show. But in a nutshell, a reverse mortgage is a loan that's specifically designed for people that are 62 and over. It allows you to convert a portion of the value of your home. I was just talking to somebody this week who said, I thought it was based on the equity. No, it's based on the value. You could have $500,000 equity in your home, but I still maybe can't do a reverse mortgage for you. If your home's worth $1 million and you owe $500,000 and you're 62 years old, I can't loan you enough to pay off the existing mortgage on the home, because the way reverse mortgages work, we have to pay off any outstanding loans on the home with the proceeds from the reverse mortgage. So if you have a $200,000 mortgage balance and we can only loan you $150,000 on the reverse mortgage, I can't do the reverse mortgage for you unless you pay the difference of that $50,000 shortfall. But hopefully that's not the case. For a lot of people, it is, unfortunately. But basically, we have to pay off your existing mortgage. And as long as you live in your home, there's 5 things you have to do. Live in your home, pay your property taxes, pay your homeowner's insurance. You have to maintain the home and keep your name on title. As long as you do those 5 things, no payment is ever required on a reverse mortgage. You can make payments. It's a payment optional program. And I think I did a program recently about the benefits of making payments. But go to my website at reversemortgageradio.net. You can check out the last, I think now 7-8 years I've been doing this show. And all the shows are on my website. But anyways, no payments are required, but you're still charged interest rate and interest on the loan. So what happens? How does that work if you're charged this interest, but you don't pay it? Well, the interest gets added to the loan balance. Every month, your loan balance gets a little bit bigger and bigger and bigger because the interest you're not paying out of your pocket gets added to the loan balance. It benefits you tremendously by not having to pay a principal and interest mortgage payment. Now, you do have to pay your taxes and insurance, remember, because the house stays in your name. It's still your home. You can add a bedroom, you can paint it purple, whatever the case may be, as long as you maintain the home and live there and all that stuff. Pay the taxes and insurance. Okay, there's also, real quick, there's 4 different ways you can draw money from a reverse mortgage. A lot of people will use part of it, at least, to pay off their existing mortgage. That's a lump sum. You take the money in a lump sum. You can also set up a line of credit where the money will always be available to you. Okay, down the road, let's say you don't need it for 10 years and then you need it 10 years later, it'll be there for you. You can also receive a monthly payment. The reverse mortgage company will pay you every single month. They deposit money into your bank account over a set term, like 5 years or 8 years or 7 years and 3 months, whatever it may be. Or you could also set it up to where it's 100% guaranteed to make that payment to you as long as you're living in the home. That's called a tenure payment plan. Or you could do some kind of combination. That's the 4th option, a combination where you pay off your mortgage and that's a lump sum. And then you say, well, I need an extra $500 a month. And we do that. And then there might still be $20,000 or $30,000 or $40,000 left over that we leave in a line of credit that's available to you for emergencies. So that's a lowdown, down and dirty, real quick, how the loan program works in a nutshell. Okay. Now, I do want to take a step back in time. Let's rewind the clock for just a moment. The idea of reverse mortgages is not new. Okay. The very first reverse mortgage, if you've never heard this, was made in 1961 in Portland, Maine. A local lender helped the widow of his old high school football coach stay in her home after her husband passed away by turning part of her home's equity into cash. And he was able to pay her to stay in the home. And then when she passed away, they sold the house and paid off the loan. Excuse me. But over the next 2 decades, private lenders offered similar loans. And then there were also other programs called equity sharing programs, which really were not reverse mortgages, but they got the label of reverse mortgages. But anyways, there was a problem. There weren't any really, let's say, national standards or protections. If a bank failed or if the home value went down, borrowers could be left with broken promises or complicated situations. Let's just say that. But in the 1980s, as more and more people were living longer, and that's when the 401ks came into being and pension plans started going away, Congress saw a need for a safe, standardized reverse mortgage program that older homeowners could trust. So in 1988, they passed legislation that Ronald Reagan actually signed, allowing the Federal Housing Administration, FHA, to create what's called the Home Equity Conversion Mortgage Program, or what we call HECM, HECM. That's the name for the FHA insured reverse mortgage program. And the very first FHA insured reverse mortgage loan, the very first HECM, was closed in 1989. The designers of the program built in key ingredients to make the program work. FHA mortgage insurance was the main key ingredient, okay? The insurance is what gives lenders the confidence to make these unique loans. I mean, you're putting out this money for an unforeseen time. You don't know what's going to happen 5 years, 10 years, 15 years down the road. You don't know how the borrower is going to use the money. You don't know what's going to happen with interest rates or appreciation values, any of that stuff. So they're guaranteeing, they're helping out the lenders by giving them the confidence to make these unique loans. And it gives you the peace of mind that no matter what happens to the housing market, to the lender, or even your lifespan, your reverse mortgage will always work the way it's supposed to. Think of it, think of this mortgage insurance kind of like the guardrails on a mountain road. You hope the heck they never hit them. But if you ever do, you'd be glad that they're there to hopefully keep you safe. Hopefully you're not going fast enough where you're going to go straight through them. But anyways, think of it like that, like guardrails, if you will. Okay, now let's talk about how the insurance works. With every HECM reverse mortgage, there's two types of mortgage. Well, there's two charges, let's just say, for mortgage insurance. There's the one-time upfront initial mortgage insurance premium. That's part of the closing costs with reverse mortgages. And then there's an annual premium that's collected monthly, and that's 0.5% of the loan balance per year. For example, if you took out a reverse mortgage and you owed $100,000 on that reverse mortgage, over the span of a year, you'd be charged roughly $500. That gets added to your loan. You don't pay it out of your pocket, but it gets added to your loan along with the interest. Okay? The premiums do not go to the lender. This is not a big money thing for big banks to do. Okay? They go into a big pot of money like any other type of insurance pool. When you buy life insurance, the money, part of it goes to premiums for the life insurance company, but they have to keep a certain percentage in reserves. And that's the big pool of money that when there's a claim, the insurance company can pay it out to your spouse or your family. That's where they keep the money, in this big pool of money. It's called the Mutual Mortgage Insurance Fund with reverse mortgages. And this is managed by FHA. The banks cannot touch this money. Okay? The fund acts like a safety net for the entire HECM program. If certain things happen, like let's say a borrower lives a long life and their loan balance grows larger than the home's value, the insurance fund will step in to cover the difference. So what happens at the end of the loan? Most of the time, let's say you pass away or you have to leave the home permanently, you move to assisted living or whatever, you pass away, your heirs inherit the home. The bank does not take the home. The heirs sell the house for whatever they can get for it. They pay off the reverse mortgage and they inherit the difference. So let's say they sell the house for $600,000. You owe $250,000 on a reverse mortgage. Your heirs have to pay off the $250 with the proceeds from the sale of the home, but they keep the other $350 as their inheritance. But what if you owe $600,000 and the house is only worth $500,000? In that situation, then your heirs can just sign the house over to the lender and walk away. And the lender will sell the house for whatever they can get for it, and the mortgage insurance will pay the difference. Because the mortgage insurance the mortgage company doesn't lose any money, they're not going to come after you, your estate, or your heirs to pay the difference. And that's just one of the ways that it protects you. And this program allows lenders, when we set up the way the loan is set up, it allows a line of credit that grows over time. It guarantees, like I said, that guaranteed monthly payment is always going to be available to you. Or if you have a line of credit available, no matter what happens to the balance on the loan or the value of the home, that money is going to be guaranteed to be available to you. And then that non-recourse protection. Non-recourse is where the lender can never come after you, your estate, or your heirs that we just talked about. Okay? I got off script a little bit there. Sorry. So the premiums that are paid between the initial mortgage insurance premium and the ongoing mortgage insurance premium is what keeps the fund healthy and strong for all borrowers now and in the future. And let me stress this real quick. This is a self-sustaining system. The government is not writing checks out of taxpayer funds to do this. The premiums are paid by borrowers, and if you get a reverse mortgage, you're charged this money. And it guarantees that all borrowers, are going to pay this money and have access to the funds if it's ever needed. Okay, that's a very important point, that it's not taxpayer money. It's self-sustaining. Okay. By the way, if you just tuned in, you are listening to Reverse Mortgage Radio. If you have any questions about reverse mortgages, please call me. You need to call me, because my name is Bruce Simmons. I'm the reverse mortgage professor here on Legends Radio, and you can reach me directly at 303-513-2748. 303-513-2748 is my that's actually my cell phone. So give me a call or visit me online at reversemortgageradio.net. If you just tuned in and you want to hear the whole show, this will be up on my website next week at reversemortgageradio.net. There's a lot of other good things on my website as well. Just go there and check it out. All right. Now, let's get into the meat of the show. I want to talk about the top 5 benefits of the HECM mortgage insurance. Yes, there are benefits to you for this reverse mortgage insurance, the mortgage insurance, I should say. This is where the rubber meets the road for you as the homeowner. Okay, number 1, you're protected if your home value drops. We just talked about that briefly, but basically if the housing market goes down, or if your home doesn't appreciate like is expected, we always build in a 4% appreciation rate. Sometimes, historically, that's about average. But during that time period, it's not 4% every year automatic. In 2008, it dropped by 40%, and then there were plenty of years where it was growing by 10 and 12 and 15% appreciation. So, but if you happen to have to leave the home or pass away in one of those down years when the loan comes due, that's when you could end up upside down on the house. Now, it doesn't matter. Let me stress this. If you live in the home, if you're living there and you're paying your taxes and insurance and maintaining the home and all that, it doesn't matter what happens to the value. The value could drop. You could be upside down by $100,000. It makes no difference to you. That money that's available to you, and we'll get into this too, is always available to you, okay, if you have any money available. And it doesn't matter if it goes down. You can continue to stay there. Nobody can ever kick you out, okay? But let's say you take on your reverse mortgage today on a $500,000 home. Years down the road, the loan balance has grown to $600,000, but due to market decline, the home is only worth $450,000. You or your heirs, maybe you have to leave the home, And you could choose to sell the home, or one of the really good benefits about this is let's say grandpa built a home with his own two hands, and then you as the son or daughter get a reverse mortgage, and your kids want to keep the house. They can still keep it even if you're upside down on the house. So let's say the house is only worth $450. Let's do it $400 to keep the numbers simple. But you owe $600 on the loan balance. That doesn't matter as long as you're living in the home, but then you pass away. Your heirs inherit the home. And one of your grandkids says, hey, Grandpa built this house with his own two hands. I want this house. He can keep that house if he wants to. He does not have to pay the full $600 that's owed. He only has to go get a loan for 95% of the actual value at the time, which let's say is $400,000. So he gets a new loan for $380,000, 95% of $400,000. And the bank has to accept that money and pay off the loan. That's paid off. And then they'll file a claim with the mortgage insurance company for the difference. And that way, your heirs are not going to be left, if they want to keep the house, they're not going to have to pay the full amount. And if they don't want the house, then they just sign it over to the lender and walk away. They don't even have to mess with selling it. This is called the non-recourse feature. And this is a huge, huge benefit to you, the homeowner. I mean, it can protect other assets in your estate. Okay, that's the first one. Number two, the line of credit is guaranteed to grow. Let's say you take out a $100,000 loan, but I tell you, hey, you know what, John, you can borrow $200,000 on your reverse mortgage. And you say, I don't want $200,000, I only want $100,000. Well, you take $100,000. That other $100,000 that's available to you gets set aside in a line of credit. And one of the most powerful features of the HECM program is the line of credit grows over time. Whatever portion of your available funds that you don't use up front grows every single month at the same rate as the interest plus the mortgage insurance premium. So let's say the interest rate is 6%, the mortgage insurance is 0.5%. At 6.5%, you're actually being charged on the loan. Your line of credit is growing at that same rate. If your interest rate goes up to 7, your line of credit's growing at 7.5. If it drops to 4, your line of credit's growing at 4.5. And this means if you set up a reverse mortgage early, let's say in your mid to late 60s, which is what I plan to do, your line of credit can grow substantially over time, giving you a powerful emergency fund for future needs. That's just, it's amazing the benefits that this can offer you. And here's the key. The growth is guaranteed by the FHA mortgage insurance. If that insurance wasn't there, there's no guarantee that line of credit would even be available, let alone growth. So even if the lender goes out of business or your home value declines, that line of credit will still be there for you when you need it. I often tell clients, think of it like planting a tree. The sooner you plant it, the more it grows. And FHA mortgage insurance is what guarantees it to keep growing. The third benefit is the payments and line of credits are guaranteed to you, even if the lender goes out of business, 100%. Guaranteed. So over the years, one or two lenders, I know of one lender one time that did go out of business. I think it was 2022. But every single borrower kept receiving their monthly payments, or they still had their line of credit available and growing. Why? Because FHA stepped in and took over the responsibilities of the lender until they found a new servicing company to take over the loan. That's something you don't get with most financial products. The reverse mortgage isn't tied to one company's survival. It's backed by the federal mortgage insurance program. That's a gigantic benefit. Number 4, you and your heirs are never personally liable. And I touched on this before, but basically if you leave the home or you pass away and the reverse mortgage becomes due, but neither you nor your heirs are ever personally responsible for the loan beyond the value of the home. Obviously, if there's equity in the home, your heirs are going to want to sell it and keep that equity. But if there's not, they don't have to worry about it. They could just sign the house over to the lender and walk away. Or if they want to keep the house, remember, they only have to pay 95% of the value, not what's owed on the home. And so it's, again, another big benefit. All of these are huge benefits. So let's recap real quick because we're coming up on number 5. So number 1, you're protected if the home value drops. You're not going to be responsible for it. Your line of credit is guaranteed to grow over time. Payments and line of credits are also guaranteed even if the lender fails. You and your heirs are never personally responsible. And number 5, the 5th benefit to having mortgage insurance is it keeps the program safe for everyone. The mortgage insurance isn't just for one borrower. It's for the health of the entire program. The premiums that get paid go into a mutual fund, which is carefully managed by HUD and audited every year. This ensures that the HECM program remains strong for future generations of homeowners. It's a system where everyone pays a little, and in return, everyone receives a powerful set of these guarantees. Without the insurance, this program simply wouldn't not exist in its current form. That's the bottom line of it. That's why this is so beneficial. Okay, let's imagine, just think of it this way. Jack and Mary, they're both 68. They take out a reverse mortgage, set up a line of credit, and they don't touch it for 10 years. Over that time, their available line of credit grows significantly with all those guarantees we talked about. And it's all because of the mortgage insurance. Okay, when Jack needs the money, let's say, for in-home care at age 78, they tap into the line of credit to cover expenses. No need to sell any investments during a downturn, or no need to take on any new debt to pay that, to pay for his in-home care. Years later, his wife Mary passes away, the home sold. Let's say the balance is higher than the value, but the kids do not owe the difference. The insurance fund covers it. That's how the program was designed to work, to give families options, security, and time. All right. So why does the HECM program have mortgage insurance? Because I would say it is the backbone of everything that makes this program safe, flexible, and dependable for homeowners just like you. I mean, it protects if your home value drops. It guarantees your line of credit will grow. It makes sure your payments will continue even if the lender fails. And it shields you and your heirs from any personal liability. It also keeps the program strong for future borrowers. If you'd like to learn more about reverse mortgages, or if a reverse mortgage might fit for your retirement plan, you need to give me a call. Give me a call at 303-513-2748. 303-513-2748. My name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage, and I am the reverse mortgage professor here on Legends Radio. But you can also visit me online too. Don't forget that. My website is reversemortgageradio.net. reversemortgageradio.net. I'm always happy to answer your questions. Thanks so much for listening to Reverse Mortgage Radio, and I'll see you next time. Have a great day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.